Mr. Scire.
Mr. Chairman, Ranking Member Shelby, members of the committee, thank you for the opportunity to be here today to discuss FHA's mortgage insurance program. Since 1934, FHA has been an important player in the mortgage market, especially for first-time home buyers. FHA insures these loans under its Mutual Mortgage Insurance Fund. Almost 1 year ago, HUD released the results of the latest independent actuarial review showing that the capital ratio used to measure the financial soundness of the fund had declined to 0.53%, well below the statutory minimum of 2%. At the request of this committee, we have been evaluating the program and issued our first report yesterday. Overall, our work pointed to further actions needed to better evaluate the fund's financial condition and guidance for rebuilding the capital ratio. Let me start by describing the reasons for the capital ratio's steep decline since its peak in 2006. Put simply, the capital ratio declined because its numerator, the economic value of the fund, declined sharply, while its denominator, the insurance in force, grew rapidly. Let's take first the insurance in force. This measure of the amount of all loans FHA insures rose as the demand for mortgage insurance grew. By the end of 2009, FHA had outstanding insurance that was more than 6 times the level it had at the end of 2006. The decline in the fund's economic value was due to several factors, including more pessimistic forecasts for house prices, which would result in higher claims, and more pessimistic assumptions about losses. From a budgetary perspective, the worsening expectations for loan performance ultimately resulted in HUD recognizing a $10 billion increase in the cost of the program in 2009 alone, and a like reduction in the program's capital reserve account. If this account, which now stands at $3.5 billion, were to be depleted, FHA would require additional federal funds to cover its cost on outstanding insurance. It's important to note that the economic value of the fund depends in large measure on cash flows derived from estimates of loan performance over a 30-year period. FHA and its contractor have enhanced their methods for assessing the fund's financial condition, but there's more that FHA can do to improve the reliability of its estimates. In particular, past reviews have relied on a single economic forecast to determine compliance with the 2% requirement. However, this approach does not fully account for the variability in future house prices and interest rates, and therefore may tend to overestimate the fund's value. We recommend that FHA use an alternate approach, known as stochastic simulation, to estimate the fund's capital ratio for purposes of assessing compliance. This approach uses hundreds of different economic paths and offers the prospect of more reliably estimating the fund's economic value. Beyond steps to improve how it measures the fund's health, FHA has also taken and proposed steps for improving the fund's financial condition, and the Commissioner described many of those. However, FHA has not specified when it expects to return the fund's capital ratio to its minimum 2%, nor what further steps it needs to take to do so. Likewise, the Congress in 1990 specified when it expected FHA to first reach a 2% ratio. It did not specify what it expected of FHA should the ratio subsequently fall below 2%, or specify a time frame for returning the capital ratio to 2%. Finally, we report on changes in the performance and characteristics of FHA loans. The delinquency rate for FHA-insured loans increased in recent years. However, in some respects, the characteristics of the most recent FHA loans are less risky than in past years. An increasing share of FHA-insured loans went to borrowers with higher credit scores, for example. Also, loans with seller-funded down payment assistance are no longer permitted. On the other hand, FHA insured relatively more streamlined refinance loans in 2009. But probably most important to consider is the sheer size of recent loan cohorts. Because these loans now represent a substantial portion of FHA's portfolio, they will be important to the future of FHA and its efforts to rebuild the financial condition of the fund. Overall, the challenge FHA faces today is not dissimilar to that it faced nearly 20 years ago, when it was first required to achieve a 2% capital ratio. It met that challenge in 5 years. then as now, it may be necessary for the Congress to specify the time period it expects FHA to return the capital ratio to 2%, taking into account FHA's statutory operational goals and its role in supporting the mortgage market. Also, to provide the Congress with more reliable estimates of the fund's value, there's more that FHA can do to more fully recognize the impact that volatility in house prices and interest rates may have. We are committed to providing the Congress with effective oversight of the FHA program, including its efforts to rebuild the fund's capital ratio while serving an important role in the mortgage market. We look forward to supporting the committee's efforts. This concludes my opening remarks. Thank you again for the opportunity to speak today. I'd be glad to take any questions that you may have.
Well, thank you again, Mr. Scire, and thank you and your staff as well for the work you've done.